Your CPA has been with you for years. They know your practice inside and out. They've prepared your tax returns, helped you with deductions, and saved you money along the way. But when it comes time to sell your practice, the valuation your CPA sees and the valuation a sophisticated buyer sees are often very different numbers. And that gap can cost you six or even seven figures. I'm Jennifer Arsenault, founder of Executive Valuations. Over the last 8 years, I've worked with hundreds of healthcare practice owners, helping them to understand the value of their businesses through EBITDA-based valuations. Today, I want to explain why tax efficient and market ready are not the same thing, and why understanding that difference before you ever speak with a buyer can dramatically change your outcome. Most practice owners assume the financial statements used for taxes are the same financial statements used to determine value. They're not. Your CPA's job is to accurately report financial results and help you minimize taxes. That's exactly what they're supposed to do. My job is different. I'm looking at the economic performance of the business and determining what earnings are likely to transfer to a new owner. I often see practices that appear very similar on paper but have significantly different values once we normalize the financials. The risk isn't that your CPA made a mistake. The risk is assuming your tax return tells the entire story about your practice's worth. Many owners discover the difference a bit too late once they're already evaluating an offer, and by then, important expectations have already been formed. The term you'll hear in virtually every acquisition conversation is EBITDA, earnings before interest, taxes, depreciation, and amortization. In simple terms, EBITDA represents the earnings a buyer expects to receive after they take ownership. A buyer isn't purchasing your past. They're purchasing your future cash flow. That's why buyers look beyond the tax return and evaluate items that won't continue after the sale. Those adjustments are called normalization adjustments, and they're where much of the valuation work happens. I've seen six-figure adjustments create seven-figure differences in value once a multiple is applied. That's why understanding your EBITDA before you negotiate with a buyer is so important. Owner compensation is often one of the largest adjustments. If you're paying yourself significantly above or more likely below market compensation, a buyer will normalize that amount to what they believe it would cost to replace you. Real estate is another common adjustment. If you own the building and aren't charging yourself market rent, a buyer will need to account for that. Personal expenses running through the business can also be adjusted out, as can one-time expenditures such as major renovations or unusual events that won't repeat. The goal isn't to manipulate the numbers. The goal is to understand the true earning power of the practice from a buyer's perspective. A lot of owners believe they can simply hand over a profit and loss statement and receive an accurate valuation. In reality, the process is collaborative. I review financial statements, balance sheet, provider production, collections information, and supporting documentation as needed. Then I meet with the owner and walk through the financials line by line. I'm looking for context. Were there unusual expenses? Was there a temporary disruption? Are there items buried in the books that need to be looked at again, perhaps adjusted out? The more complete the information, the more accurate and defensible the valuation becomes. One of the biggest mistakes I see is waiting until a letter of intent arrives before trying to understand value. By then, the buyer has already analyzed comparable transactions, estimated your EBITDA, and formed an opinion about what they're willing to pay. If you don't know your own normalized EBITDA, you're negotiating at an information disadvantage. An independent valuation gives you a baseline. It provides clarity, confidence, and a stronger negotiating position before emotions and deal momentum take over. If you're thinking about an exit, even if not for the next 2, 3, or 5 years, start preparing now. The smartest thing you can do is have an independent assessment done so you understand your normalized EBITDA and the factors that influence value. In my experience, the most successful transitions don't start with offers, they start with information, preparation, and clarity. The better informed you are before the conversation begins, the stronger your position will be when it matters most. If you found this helpful, watch for my next video in which I explain exactly what happens during evaluation, and follow me for more content on practice value, EBITDA, and preparing for a successful transaction. I'm Jennifer Arsenault with Executive Valuations. Thanks for watching.